Ladies and gentlemen, good day and welcome to SBFC Finance Limited Q3 FY24 earnings conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Renish Bhuva from ICICI Securities. Thank you and over to you, sir.
Yeah, hi. Thank you, Nirav. Good morning, everyone. Welcome to SBFC Finance Q3 FY24 on this call. On behalf of ICICI Securities, I would like to thank the SBFC management team for giving us the opportunity to host this call. Today we have with us the entire top management team of SBFC represented by Mr. Sindhu, Managing Director and CEO, Mr. Mahesh Dayani, Chief Business Officer, Mr. Narayan, Chief Finance Officer, Mr. Pankaj Poddar, Chief Risk Officer. I will now hand over the call to Mr. Singh for his opening remarks and then I will open the floor for Q&A. Over to you, sir.
Thank you, Renish. Good afternoon, everyone, and thank you for being on our Concall. This is our third call post listing. Just giving you a little bit of highlights of the quarter. We had a rating upgrade to AA minus stable from India Ratings. We had a stable AUM growth beyond the upper end of the guidance that we have given. We had a stable asset quality for the quarter. There were stable spreads and NIMs, and we don't accrue interest from the date of the NPA, so you'll have to keep that in mind. But it was stable, both spreads and NIMs in a rising interest rate environment. OPEX, has been, for the year, we began with 5.8% and we had guided a 50% glide path into the year, and we are on track. We should be on that path. Very happy that the ROE has climbed back to 11%. That was a level we had done pre-IPO. And on an expanded equity in 2 quarters, we are now back to an 11% ROE for the quarter. While you're looking at the profit growth, you'll have to keep in mind that the benefit of the fully deployed funds of the IPO proceeds during the quarter kicked in, and therefore there is a slightly higher than normal profit growth during this quarter. But those are the big highlights of the quarter. We'll now request Narayan to take it from here.
Thank you, Asim. Good morning and wish you a very happy and healthy year 2024. We thank you for joining this investors call. Let me take you through some highlights of the financials for Q3 FY24. The AUM as of 31st December 23 is 6,266 crores, which has grown at a 40% on a YOY basis and 8% on a QOQ basis. We have seen a sharp increase in the repo rate and therefore interest rates over the last 2 years have increased. Since majority of secured MSME loans are on variable interest, we have been able to maintain the spreads of about 7.5% throughout this last 2 years. The spread for 9 months ending December 23 are 7.47% against 7.44% for the previous period of 9 months ending December 22. We have recently got rating upgrade, as Asim was mentioning, from India Rating from A plus stable to AA minus stable. The operating leverage has been improving consistently and accordingly OPEX to AUM ratio has reduced from 5.84% for 9 months ending December 22 against 5.48% for 9 months ending December 22. Our GNPA remains steady at 2.38% as of December 23, therefore leading to credit cost of 0.8% of AUM with PCR of 43.5%. We have reported CPOP growth of 20% on a QOQ basis and 56% YOY basis for Q3. We have a PAT of 64 crores with 22% QOQ growth and 63% growth on a YOY basis. CRAR is to 41.5% as of December 31, 2023. Thank you for patient hearing. We are happy to take questions from you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Renish Bua from ICICI Securities. Please go ahead.
Yeah, hi sir. Congrats on a good set of numbers. Just two questions from my side. One on the asset yield expansion, which stood at almost more than 30 basis points on sequential basis. So can you please throw some light what is happening on the asset yield side, sir?
Asset yield. Asset yield. Okay. So overall, if you look at our overall ticket sizes for the quarter, our ticket sizes have come down marginally to almost 9.3, and they were closer to almost 10 odd lakhs in the previous quarter. So one is obviously there's a sequential improvement as your ticket sizes goes down. Your yield, there is a positive movement that comes through. We've always been guiding that our ticket sizes are going to be in the range between 9 to 11. So we've stuck on to that particular range. So there's been some bit of benefit that has come or got accrued due to movement towards the lower tickets for this particular quarter as well.
But, sir, I mean, see, that will be only on incremental basis. But when we look at the book yield, it is sharp 30 basis point up move.
So that's also, if you remember in the previous quarter, so there was a one-time adjustment largely related to the stopping of accruals on the NPAs. So there was an amount of almost close to around 5 crores which was not recognized due to the accrual of interest. So that's now been, that's the one offset that you see in this particular quarter which is normalized, and majority of the bump up is also happening because of this.
Got it. And just to follow up on that, so going ahead, considering the rating upgrade also, and let's say if this uptick in the asset yield continues, or even if it remains flat at current level, how should the spread, let's say, behave over next 2 to 3 quarters, sir?
So we've been maintaining that, one of the key things on our ME book is that most of the book, almost 98% of the book is variable. And we've always been maintaining that the spreads are going to be in the range of 7 odd %. We don't expect that the yields are going to move up significantly up from here, but we will be able to maintain the yields. The rating upgrade which has come in, and it has come in this particular quarter, is probably going to help us rein in the increase in cost of borrowings, which will also probably complement us to maintaining the spreads that we've been maintaining.
Okay. No, sir, the thing is that, though our guidance is 10%, but we are actually running, much higher currently. And considering the fact that, the rating upgrade will also lead to some bit of moderation in cost of borrowing. So of course we're going to remain about 10% for sure in near term. So I mean, internally, how do you look at it?
See, Renish, at this moment the banking system liquidity is extremely tight. So as you know, RBI just did a VRR of almost 2.5 lakh crores. So the system liquidity is deficient at 3.5 lakh crores. In such an environment, being able to negotiate a lower interest rate from banks, doesn't seem to be a probability. Of course, that would be the attempt. But what it would do is that it may stem the increase in interest rate that otherwise would have come. Because as you see, last quarter, our cost of funds didn't move up despite the 25 basis risk weight being moved up for banks, for NBFC lending. And we were able to defend it because of the rating upgrade. So at this moment, in the current situation, if the rate of interest doesn't go up, that's victory. Thinking that will come down in this market environment, is little too optimistic.
Got it, sir. And just a last question from my side, on the 1+ TPD movement. So of course it has gone up by 30 basis point sequentially. but it still remains within the range bound, let's say 5.5 to 5.6. So any color on that? I mean, why there is a sequential increase?
So as we have guided earlier also, so our model bakes in the 0 plus at 5.5 to 6% range. So we expect that to remain in this range, and we do not expect any incremental issue or risk coming from this.
Got it. This is very helpful, sir. Thank you and best of luck, sir.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Nischint Chawathe from Kotak. Please go ahead.
Hi, congrats for a good set of numbers. My first question is actually on the borrowing side, I think, which you sort of partially answered. But going forward, looking at the tight environment and probably some benefit of rating upgrade, you kind of seem to be pretty confident that you will have a stable borrowing cost. Having said that, I think if I look at your business mix, I think for some of the other players, we have seen PSU banks business, borrowing mix going up, and the kind of negotiation that they have over there probably gives them some comfort or confidence on their borrowing cost. In your case, that's not really the case. I think your FIs are going up, so I'm just trying to understand, what are your incremental borrowings, and probably if you could give some color on incremental rates as well.
So see, what you said is right. The liquidity is tight in the market. The other thing which has happened is the risk weightage on NBFCs has been increased, right? So these two combined actually gives an answer that the cost of borrowing should actually go up. Now, incidentally, if you see our cost of borrowing for the last 2 quarters, let's say September quarter and December quarter, you will actually see that the cost of borrowing has remained stagnant. Good thing which has happened is recently we have also got rating upgrade. So keeping all of these in mind and also a very high CRAR we carry, so the pressure is a little bit better. It is slightly low, and so I think we feel that we should be able to hold this cost of borrowing. But yes, the liquidity is obviously tight.
Actually, Nischint, as you know, the ability to negotiate interest rate depends on the desperation you have for borrowing. At this stage, we are sitting on 600-700 crores plus of approval sanctions, from various people. So I don't think, while liquidity will be tight, it is plenty for us. So I don't think that there is a problem of funds. It is now just a negotiation of rates. So because you guys keep needling the banks that your NIMs are less, then they come after us. So it's all your fault only. So effectively, see, it's a process of give and take. It's a process of negotiation, and we will hold back on our sanctions till we get the right borrowing cost that we are also comfortable with. And at the end, we have to manage the spreads, and the NIMs, which we have even as you have seen over the last 2 years, that even in a rising interest rate environment, our spreads and NIMs have only gone up. They haven't come down. So that is the art of management, and that is what we will be doing.
I take the point on margins, but more on the borrowing costs is what I was looking at. And what is the FI share that is going up in your borrowings? I mean, I can see public banks are coming down. Or in fact, banks as a share of borrowings is coming down.
No, so we have not added a lot of FIs in borrowing. Possibly what you are seeing is the co-origination going up. The other thing which has gone up with the EC, we have borrowed from FCNB. So we have borrowed some money from the bank under FCNB, and that is going up. So the bank shares remain, including FCNB. If you compare, if you look at the data, it is also the same. But yes, we would intend as we go along in future, to borrow more from mutual funds, DFIs, and things like that. But yes, including everything put together, we would still want our cost of borrowing to remain where it is today.
The issue of financial institutions going up, so...
Yeah, so that, I'm just opening the chart here. So that is possibly the FCNB borrowing we are talking about.
So SIDBI and Bajaj Finserv, Birla Finance, Mahindra Finance.
Yes. No, so that name was the same. That percentage borrowing has not increased significantly there. It's still the same.
See, we really haven't materially borrowed anything last quarter. I mean, we didn't need to, considering that we are still deploying the IPO.
So
if you look at the presentation you have, it is 10.5% and 10.6% now. It's almost the same.
The second one is on gross stage 2 levels. If you could give a normalized guidance for this.
So stage 2
stage 2 level comforting here.
Yeah, sorry. So stage 2 basically has gone up as per the numbers from Q1 to Q3, and that is largely due to gold loan. For MSME, the number is stable at 4%. For gold loan, the same has seen an increase, where we do not see any incremental risk coming in. We are able to resolve these customers while they go into NPA through auction and other process.
How periodically do you do these auctions?
We have a monthly and quarterly process based on the staging of the customer. So it's a predefined process, and we don't largely see any loss coming through auction. So we don't see post loss there.
Comment if you could give qualitatively, and that is essentially on competition that you really see in the MSME business. You see new players who are coming in, some IPO-bound companies who are trying to sort of get more aggressive in the market. Obviously, your margins speak for, your yields are obviously speaking for, how do you see the way forward?
So from a competitive intensity, obviously you would have players, largely on the regional side. The competitive intensity was there last year, it was there in the previous quarter, it continues to be there in the current quarter as well. But as we've always been, talking about and guiding, saying that the market can accommodate enough number of players. It's just that the segment is how well you've defined. And the segment that we've defined for us is between 5 and 30, and which even today is currently growing at a compounded basis of almost 20 to 23 odd percent. So within that space, I guess there's enough headroom for us to, grow from where we are. We're currently at 6,000 odd crores, out of which MSME is almost 5,000 odd crores. So we don't see that probably the growth is going to be moderating. We feel that 5 to 7 that we've always been guiding for is sustainable and consistent from here on as well.
And all the best.
Coming to your last question, which you asked me on the FI actually has gone up from 10.5 to 17.4%, and that is because of incremental money coming from Citi. Okay, and that is at a competitive price.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Chirag from Intellect Stock Broking. Please go ahead.
Good morning, sir. Hello.
Chirag, your audio is not clear. Can you please speak through the handset?
Yeah, so basically, congratulations on a good set of numbers. My question was that in the industry we exist, the presence of strong competitors like Poonawalla Fincorp and Manappuram Finance has diluted the market, wherein the NIMs hover around 11 to 13%, whereas ours stand at 9.3%. What are the anticipated challenges that can be seen in the forthcoming future, and how well are we prepared to tackle the same?
Sorry, your audio wasn't very clear. I'm sorry, but can you repeat the question again, please?
In the industry we exist, the presence of strong competitors like the Poonawalla Fincorp and Manappuram Finance has diluted the market for MSME lending, wherein the NIMs hover around 11 to 13%, and ours stands at around 9.3%. So what is the anticipated challenges we are going to face in the upcoming future?
So I think the names that you just mentioned, on one side has a high incidence of unsecured, and on the other side you have gold, which contributes a majority of the portfolio. So you don't really mirror the portfolio segmentation on both accounts. For us, gold contributes close to around 15 odd %. MSME contributes close to around almost 85%. Currently it's 83. but in both the cases, both are extremely different. We have largely a secured book, a very small unsecured book, but probably by the end of the year is going to run down. So if you look at our composition of the assets, that's very differently placed, and hence probably there is going to be a difference in terms of the NIMs that you would look for a standalone gold or probably on a standalone unsecured book. But as we mentioned earlier, I think the best way to look is the spreads that we've always been maintaining, and we've always been guiding that our spreads are going to be largely, we'll be holding on to the spreads, even in an environment where the rates were extremely volatile, but we stuck on to our spreads of 7% and above all through the last 4 quarters, and that's what we've been guiding for the near future as well.
Okay. And that's the last question. So, you have been mentioning that the risk weight has been increased as per the RBI guidelines. So, what is the amount of risk capital we are maintaining, and also, like, what is the concentration ratio as to the borrowings you have been providing?
No, so risk weightage has increased for the bank from a bank's point of view. From our point of view, the CRAR we are maintaining is 41.5%. So it is a pretty good equity in the organization. From your second question on cost of borrowing, I think as I was saying previously, we are doing enough and more to keep the cost of borrowing in control. And also particularly since we have got a recent rating upgrade from India rating to AA-, our ability to keep the borrowing in check is pretty much there.
Okay. Thank you, sir.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. A reminder to all the participants, you may press star and 1 to ask a question. The next question is from the line of Franklin Morales from Equentis Wealth Advisory. Please go ahead.
Yeah, hi. Thanks for taking my question. So could you share your guide path on the OPEX to AUM ratio, and which are the regions which you are planning to focus on?
So as I said in the opening comment, we began the OPEX to AUM at 5.8% for the current financial year, and we had guided a 50 basis point reduction over the year. We are on that path. By March, as we exit March, we should be on that path. And we are in 16 states, and we are equally focused on all these states. And some states we have penetrated better. Some states we have to do a better job of. We are equally focused on all states to ensure that we have a balanced growth across states and do not have concentration in 1 or 2 states.
So beyond this 50 bips reduction, is there further scope for improvement in this OPEX to AUM ratio, or should we consider this as more stable?
No. Next year also we are planning to work. Don't worry. So this is not the only year. See, ultimately what we have done is that we have created, when you do a 16-state setup, you have created an infrastructure where you have invested upfront. So all the investments need to be sweated out. So right now we are not a company at scale. We are still a company that is growing. We are still at an early stage of our business. So there is a lot to be done before. Next year also 50 basis point reduction in OPEX should come through. So hopefully then we'll get after that for the year after that. So ultimately, as the AUMs grow, as the company matures, as the setup grows, we don't need to make investments in people to the level that we have already done, and therefore those benefits will accrue into the P&L.
So, sir, from a kind of a steady state scenario, what kind of a number should we more look at for your business model?
Right now you can look at in the 5.3, next year you can look at 50 basis points lower. उसके बाद में देखेंगे यार उतना हुआ सीन रहे. See, you can't play the 18-hole golf course all at once. You played one hole at a time because that's all you can see. So we at the moment we can see the current March hole and we can see the next March hole. So that much we can tell you. Beyond that, when we reach September next year, then we will discuss what we'll do thereafter.
Okay. Great, sir. A lot.
Thank you.
Thank you. Next question is from the line of Umang Shah from Kotak Mutual Fund. Please go ahead.
Yeah, good afternoon. Thanks for taking my question and congratulations on a good quarter. I just had two questions. One is on the AUM growth, right? I mean, clearly the growth is looking extremely strong at this point of time. What should be a more steady state, sustainable sort of a growth rate for us? And also, do we intend to add any new products, at least in the foreseeable future?
So our growth has been at 8% on a quarter-on-quarter, and on an annualized basis, that's more like 40-odd%. We've always been saying that 5 to 7 looks as a more sustainable and a matured growth outlook, and that's what we commit, and that's what we've always been guiding for, and that's been our current stand as well. As far as moving forward, we are not adding any more products because I guess the last 3 to 5 years, if you probably take off 2 years of COVID, a substantial amount of investments have gone in creating the entire ecosystem and the infrastructure of building MSME in those particular markets and states. And at least for the next 8 odd quarters, the distribution is yet to sweat in. And the growth part is something that we'd like to demonstrate along with quality. So having said that, we'd like to remain focused on the MSME play, where it would contribute almost 85 to 90% of the total book.
Understood. That's helpful. And the second was on co-origination. I mean, should we assume that the share of co-origination inches up in the overall mix, and if so, up to what extent?
So currently, our total co-origination percentage on an AUM is close to around 18-odd%. We've been talking about 15 to 20% of the disbursals is what we will co-originate. And that's what we are comfortable with. And moving forward, you would probably see us in the similar range-bound percentages as we inch up our disbursals and our AUM further from there.
Okay. And the last one was sort of more of an extension to the question what the previous participant asked. So in terms of your branch expansion, as you rightly said, we have roughly about 1/4 of our branch network, which is currently sort of lower vintage or lesser utilized. But at the same time, as we keep growing at, let's say, 25 to 30-odd%, we'll need to keep adding more capacity as well. So from that perspective, should we assume that a more 5.3 to 5.5 is more like a sustainable cost to asset, at least in the near term, till the time the balance sheet becomes a bit more larger, and only then a material improvement comes through in terms of our cost ratios? Is that a fair assumption to make?
I mean, I would say that's a conservative assumption to make, but let me just explain the context here. So I guess a large amount of your investments, come in at the time when you start a particular state, and the investments are largely on account of the infrastructure that you create, not in terms of physical infrastructure, but the ecosystem around origination, underwriting, audit, operations, fraud control, risks. That is a substantial investment that one makes. Once you have established that and you have some runway, some color of origination that you are making, and you are a lot more stable on the ground, then expanding your branches, expanding your routes is not a very expensive affair. So the marginal cost, on a marginal cost basis, the investments are not going to be very large, except for obviously adding more boots on the ground. And that's the reason why Aseem in the opening remark and subsequently mentioned that we are fairly confident that despite adding 25, 30 odd branches on a yearly basis, we are fairly confident that the OpEx as a percentage is going to come down by 50 basis points for this year and next year as well. So clearly, I think the way it is, even if you look at our branches which are more than 3 years are averaging close to around 45 crores per branch. The branches which are between 1 to 3 years are in the range of 35 odd crores per branch, which is only talking about that we are investing. We are looking at how the origination is moving in these set of branches. So we're not in a hurry to add 100 branches because we would want to add distribution, see that those set of branches are getting profitable, and then probably again add the next set of branches. So I guess that's what the entire philosophy is, and that's what we would probably stick to for the next 4 or next 8 quarters as well.
Perfect. That sounds good. And just one last clarification. All our sourcing is in-house, right? I mean, we don't really rely on third-party sourcing.
Yes.
Okay.
So the 3,500 headcount that you see probably in our investor presentation just represents a higher number because of everything being done in-house.
Perfect. All right, great. Thank you so much and wish you all the best.
Thank you.
Thank you. The next question is from the line of Tushar Sarda from Athena Investments. Please go ahead.
Yeah, thank you for the opportunity. This is the first time I'm attending a call of SBFC. I just wanted to know what is your trajectory going to be in terms of leverage, because right now the leverage is low and obviously that depresses your ROE. So over next 2-3 years, how would that play out?
So yes, you are right. Post IPO, the leverage, the debt equity has come down to 1.5. So if you look at all the banks covenant we have signed with all the lenders is roughly 5 debt equity. So, but the liquidity markets are so tight, it is difficult for us to talk about 5. But what we believe is something anywhere between 3 and 4 is something achievable. And so once we start reaching 3, and that's where we will think about whether to raise fresh equity or to move towards 4.
The way to look at it is that from here onwards, the entire growth will be debt fuel. So we have done our round of equity rates. Now, at least until we exit FY26, it has to be a debt fueled bit of growth. So whatever growth that you see, which will come from additional borrowings that we will be doing. So leverage automatically will kick in.
Yes, no, that I follow. What I'm asking is by FY26 end, what would you be in terms of leverage, debt to equity?
You come down, by senior management meetings. It is very simple, man. We are saying 5 to 7% quarter on quarter growth is what we are doing. Now you do the math, that if you are doing 5 to 7% quarter on quarter growth, and for the next quarter till FY26, what would be our total AUM? And of that, when the equity is already fixed, the balance is leverage.
Okay, thank you.
Thank you. A reminder to all the participants, you may press star and 1 to ask a question. Next question is from the line of Avinash Singh from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. 2 questions. First one is on co-lending coordination. Given that you have built an extensive branch network and you have like 3,500 strong workforce sourcing done, and it's particularly in the PSL segment, most of your loans will come. That is where many of the banks, particularly public sector banks, would be very sort of interested in doing co-lending kind of arrangement. So why sort of you are relatively a bit guarded or measured approach towards co-lending? What's your view there? That's number one. And second, you're largely into secured MSME, whereas even unsecured loan in slightly maybe bigger size MSMEs where that's a sort of business loan is in demand, and your understanding your infra and ecosystem that you develop. So why sort of you are not venturing into unsecured space with the same intensity? Thanks.
So see, the way to look at it is like this, that first we need to understand that there are 2, when people's market says co-lending, it often doesn't get appreciated. that there are two forms of lending in the market. One is CLM1 circular, the other is as per CLM2. CLM1 is co-origination, CLM2 is co-lending. So what we are doing is co-origination, which is where it's a tripartite agreement between us, ICICI Bank, and the consumer, and the entire process, is jointly vetted. So even the credit looks at every transaction prior to giving a loan, and both operations look at the documents prior to disbursing the loan. So it's a double check in a sense that happens before a loan gets disbursed, and that's the process we are following. And generally, you would have seen that all NBFCs securitize, in the good old days, 20-25% of their books. We think that instead of securitizing, taking all your books and securitizing, doing co-origination is a much smarter way to do it, and it's more ROE accretive as well. So what we have decided, and we also get the additional benefit of ICICI Bank, which is superior to us in understanding credit. We are still a small new company. They have been around and they have seen cycles.
Operator request has been initiated. If you'd like to cancel this request, please press *0 again.
Rectify them and identify them and catch it early. So the benefit is that we have a very asset-light ROE accretive model. It's a very difficult to talk. Both the operations teams on the ground have to talk. So in the country right now, we are the only game in town. There is no other working CLM1 model. We have built a 1,000 crore book. You will not find a single other such model in the country. So clearly it's a difficult thing to achieve. It's not something that it has taken us 2 years, and I would compliment ICICI Bank for being patient and all the help they did. For us, it was a big thing. For them, it's water off the duck's back. But yet they enthusiastically participated in the entire process and made it work. So it's been a lot of work, getting the programs fine-tuned, getting credit fine-tuned, getting up the valuation, legal. So many small things are there, getting all that fine-tuned, system integrations, reconciliations. There are so many minute details to it. It is not easy to do this with someone else. Doing this is as pleasurable as getting a root canal done. So you won't do it unless you have to. So co-lending is easier. Co-lending, you can have 20 partners, 30 partners, because co-lending is nothing but DA, without minimum holding period. So we like co-origination more. We think it's more value accretive for SBFC. So that's the thinking on co-origination. Sorry, what was the second question?
Unsecured business loans, unsecured MSME. I mean,
for the first time, Mr. Satyakant Das has said we are doing a good job by not being unsecured. Why are you spoiling us? We are happy. We are happy doing what we are doing. We'll do what we know. There are so many players doing unsecured. What will I do and compete with them? They are doing so many wonderful things. I have nothing better to offer. I don't have a right to win in that segment. We are very happy, building what we are doing. We still have to do much in what we are doing and get that right, rather than try to do 20 things and make a mess of all of them.
Okay, thank you.
Thank you very much. As there are no further questions, I will now hand the conference to the management for closing comments.
Closing comments. Thank you. Thank you everyone for being on this call. It's financial services at the end of the day is a boring business. So I'm really thank you for taking the time out and asking those questions. We have tried and made the presentation in such a way that hopefully most of the questions would be answered. After this also, if you have any further clarifications or doubts, happy to take calls later. Thank you very much, and see you next quarter. Thank you.
Thank you very much. On behalf of ICICI Securities Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.